Good afternoon. I think we can start the webinar now. Maybe we'll wait. We have a few participants already online. We'll wait a little bit more, maybe 1 minute, so that everybody is able to join. All right, I think we will start now. Good afternoon. My name is Laure Blanchard-Brunac. I am a senior advisor with Ruud Peterson Public Affairs. I have a background in policy and banking, and I have the pleasure today to moderate this webinar discussion hosted by Ruud Peterson on the topic of the EU Savings and Investment Union and how this policy could unlock Europe's financial capital. First, a word on Ruud Peterson. This is one of Europe's leading public affairs and strategic communications group. We serve more than 300 companies, public entities and organizations, and we have around 500 employees in 15 countries across Europe. The group was very recently awarded the Continental Europe Agency of the Year Award, Saber 2025 at the Provoke Media conference. So first, a word on the Savings and Investment Union. This is the new EU policy outlined in the communication issued by the Commission a few weeks ago on 19th of March. And the Commission says it is deemed to foster citizens' wealth and economic competitiveness in the EU as a strategy for Europe to develop and advance integration of its financial markets. It is a fundamental part of the plans proposed under the Letta and Draghi reports that were issued last year. So the SIU, the Saving and Investment Union, builds on the Capital Market Union, CMU, and the Banking Union. We will refer to these policies during the time of the webinar. And both of those were partially completed under the last Commission term of office. Notably, the SIU strategy entails significant policy and regulatory measures to ensure a greater mobilization of European savings and private capital in general to finance competitiveness and other key priorities of the EU. So we are talking now in this webinar at a time where financial markets are in turmoil, and therefore it's a suggestion today now for this 1 hour to take a pause and reflect a bit more on a long-term view on what the EU could do with the SIU implementation. Let me first introduce the speakers before we dive into the subject. We have with us Atanas Pekanov, who's a senior advisor at Ruud Peterson. He is also an economist at the Austrian Institute of Economic Research, WIFO, in Vienna, with a focus on monetary and fiscal policy and architecture of the Economic and Monetary Union. Formerly, Atanas served as a Deputy Prime Minister of the Republic of Bulgaria. He was in charge of the management of EU funding, the Bulgarian National Recovery and Resilience Plan, cohesion and regional funding, as well as the coordination of the Euro adoption process. We also have Alan Human, who is also a senior advisor at Ruud Peterson. And Alan has been between 2007 and 2023, the managing director and head of government affairs for Citigroup for Europe, Middle East, and Africa. And prior to that, he had a career with the Treasury in the UK, and he was an advisor at the UK's Financial Services Authority, FSA, as well as the Committee of the European Banking Supervisors in London. Alan also held roles previously with the Economic and Financial Committee, the European Commission, and he was an advisor to the European Banking Federation. So we have here two high-level policy experts on the topic of financial markets, capital markets, and economic policies of the EU from two very different places from Europe. Atanas, I will start with you. Could you please tell us a bit what are your key takeaways from the release of the SIU communication and the reactions, the member states' position, etc.? Thank you.
Thank you, Laure. Thank you for introducing me, and thank you for the opportunity to talk about this topic. It's a topic that I've been following now for numerous years, also as part of my academic interest in the future of the European Monetary Union and how to make it more resilient and more growth enhancing. And for me, let's start with the Capital Markets Union initiative. It was a very important initiative. It was something that, however, although we put some effort on this, progress was rather minimalistic, say. Unfortunately, because there were some expectations that especially after Brexit, there will be some opportunity for movement. And I have to say, for the 10 years that the Capital Markets Union initiative was there was some movement, much more, however, on the banking union side, which I consider was very good in some ways, important progress that has stabilized in some ways some of the bottlenecks and sort of the shortcomings of the previous architecture of the banking system in Europe. But on Capital Markets Union, we have to be honest, the progress was very modest. There was this word last year that was very trendy, demure, and demure means very reserved, very modest, and I think we can use this as a good definition of the progress on Capital Markets Union. So I welcome very much the new narrative, the new branding that the Commission has taken, pointing to the fact that Europe has a lot of savings. Very often these savings sit idle on bank accounts. This is, of course, up to citizens to decide how they invest, how they spend their money. This is completely their decision. But if in the European Union, we don't use all the opportunities to make it at least easier to use this funding, to make it easier to invest it, we are missing some opportunities. We're missing some opportunities in some important dimensions. First, because it means, well, most probably lower returns for these savings. Second, and this was very well also pointed out by the Letta report, some of these savings then are flowing out of Europe. They get invested in other constituencies, that, let's say, for a very long time was seen as very either safe haven or as bringing much higher returns. And this has to do with the fact that we have fragmentation across capital markets in Europe. And in a fragmented market, this means higher costs for the final consumer, hindrance, limitations for capital to go where it actually is needed. Capital Markets Union and our Savings and Investment Union, in the end, wants to use the power of the single market and wants to admit that, well, we haven't achieved a single market in financial services yet. We have fragmentation, and this leads to losses for the European economy. Losses in terms of growth, but also currently, it has become even more important, losses in terms of the fact that we have savings and we have investment needs, but somehow we don't manage to bind the two together. And these increased investment needs were very well articulated in the Draghi report. Immense investment needs, given the many challenges that Europe is facing. On the other side, you have the funding to use that, but we have to take some important steps to what we call mobilize this funding. And I believe the communication by the Commission pinpoints some very clear things that need to be done. Not everything. I'll have a couple of critical words at the end, but let me first point to some of the important things that are well articulated there. So first, citizens and savings. It seems when you compare all the available data, low participation of households in equity markets in Europe. If you look at the data, less than 20% of households invest their money in equity markets in Europe, whereas in the US, this is more than 50%. Again, this may be just because, for example, we have different risk aversion, or maybe just this is a conscious decision, yes, but there are policies that can enable households, if they want, to invest much more. And this seems to me as something that we should have learned from the previous years, that we don't want, for example, accumulated savings, excess savings in the pandemic to flow out of Europe and in other constituencies, not at least to that extent. And in this area, I think the increase in financial literacy, this initiative to increase financial literacy, is important, and it has to be also driven by the financial sector itself. This is very, very, very good, but it is a very long-term project. This is not going to change the landscape instantly. So this is something that will have an effect, not immediately, but maybe in some years. On the other side, there is the proposal and the goals of increasing the returns on pension savings by enabling the auto-enrollment in different pension schemes, as well as enabling better information for final for citizens through different dashboards to these pension schemes and what one can do with their pension savings. And I would say that in this area, institutional investors, pension funds, insurance funds, we have not yet utilized perfectly the availabilities that we see. Some EU member states have actually done that, have already very well integrated and well advanced pension systems. In others, I would say we see the very same fragmentation that I was talking about. Then moving to investments and financing, again, I can just reiterate the goal of the Savings and Investment Union will be exactly the fact that, well, Europe is facing increased investment needs, and it should be able to find the funding necessary for this. On the private sector side, very often used argument is the fact that, well, funding in Europe is bank-based. Bank lending is much more common in Europe. If you look at, for example, the assets to GDP size of the banking sector in Europe, it's much bigger than in the US. This is not always, let's say, a bad thing, but from many macroeconomic studies, finance studies, we know that bank-based lending often has much longer lags. So after a recession, for bank lending to recover, it takes much longer than if you had a more advanced capital market where companies can fund themselves through equity and bond issuance. So this means that Europe very often takes much longer to recover because the funding needs of companies cannot be accomplished as fast as necessary. On top of that, the fragmentation across national capital markets also leads to an inability of the European Monetary Union to provide enough risk sharing on the private side. In the end, what is the goal? The goal was you have one single market. That means the law of one price holds. You have full information, and then capital can go there where it has the biggest returns and where therefore you would achieve the best possible allocation. With fragmentation, with limitations on this, as we have it right now, this is yet, I would say, not accomplished. And one crucial part in this, and it's also mentioned in the communication, however, here I don't see it enough, is supervision, of course. To have what I mentioned, one market with the law of one price and full transparency for all investors, we want on one hand to have the same treatment. So here we have to make some important steps in terms of taxation, insolvency laws, withholding rights, but for most of it, I think really crucially, common supervision. And here I say common because there are two approaches, and some member states continue to insist, well, we need harmonized supervision. All member states do, so to say, the same supervision. My view is this will be extremely difficult to achieve because, of course, harmonizing the legislation in many of these questions is going to be very difficult. One good example that we use from the last years is always the question of insolvency law. There was the goal of harmonizing insolvency law so that investors are protected no matter where they decide to invest across the EU. This has not been high on the agenda, especially on the justice ministries in member states, because of course the justice ministries very seldomly have this overall goal of, let's say, harmonization. This is much more often the case at ECOFIN, where finance ministries meet. They already have taken many steps in harmonizing different laws and different regulations. I think at the area of justice ministries, that is much less the case, and therefore it is much less urgent, and therefore we don't have any progress. So on supervision, I'm a bit worried that, well, harmonized supervision in the end will never be harmonized. And here I would like to reflect that also President Lagarde 2 years ago in a speech, in the so-called Kantian shift speech on the CMU, where she really urged the European institutions to think about how we achieve that. she argued that, well, back 100 years ago, when the US was facing increased investment needs for railroads and for other things, this is when the SEC was created and when it actually delivered on delivering a common capital market in the US, which exactly delivered on these investment needs. And it seems to me that Europe is now in the same situation and therefore will need common supervision, which at least for now I don't see as moving politically. And this is my final point. The problem still lies at the fact that when these discussions start, it seems to me it is still the view of all member states that, okay, let me see what we can get out of this. So the overall general EU, let's say general equilibrium effects are sometimes neglected. So the fact that through harmonization, through the lack of fragmentation, you will create a single market that will create benefits much more than this zero-sum thinking that is often the case between member states. I think this is a mistake that is going on in the negotiations and will impede some of the progress. And we need this progress. We need this progress because previously we were talking about, okay, the costs of fragmentation. Now we're talking about the cost of inaction, the cost of not investing in these areas where we want to invest and where we also can invest because there is the funding available there. We just don't use it yet.
Thank you, Atanas. And we'll get back to a few of the hints you gave, especially on supervision, I think. Alan, on your side, what are your key takeaways so far on this SIU policy and maybe also linking to the CMU and the banking union, because you were, I think you were at Citigroup for a big part of your time during the implementation. Maybe you can tell us a bit more how that is in the continuity. Is there any hope that under CIU we see things happening which we haven't seen under the CMU and banking union?
Thanks, Laura. And hello, everyone. So I completely agree with Atanas's assessment. So I'll try not to repeat my underlining of my agreement. But I mean, this is such a new old story, or an old new story. I mean, I'm going back to the 1990s in Brussels. The Giovannini barriers, we were talking about these 30 years ago, and these are core integral problems with the internal market in the EU, which have never quite been completed. I mean, I remember the phrase deep, wide, and liquid capital markets was a Commission mantra 30 years ago, and we're still looking for that. So it was then a complement or a completion of the Euro project. There's a single market project, the two rebrands of the Capital Markets Union, the banking union stalled again. And I suppose it's to be welcomed. I mean, what is clear is that this is a project that needs to happen. The problem is it's very difficult to make it happen. But I think the SIU that we're talking about now brings together the wholesale and the retail sides. I think those previous projects were very esoteric for the European citizen. They were behind the scenes. You'd never see the integration of infrastructure. But now we're talking about utilizing savings, directly involving the citizen. As Atanas said, financial literacy and education is going to be a key part of this. I think that's absolutely right. And of course, it's now even more urgent. People say, why is it more urgent? Well, the old reasons are still there. The need for capital. The European infrastructure is old. Bridges are falling down. It costs an incredible amount of money to rebuild this. Then we have the, not newer, but even more pressing, perhaps, the ESG climate change needs capital, huge amounts of capital, trillions of dollars or euros of capital. We have the digital transformation, which is going to demand a lot of capital. We have social cohesion, the core and the periphery of Europe, very different economies. That's going to need a lot of capital to bring everyone into, social solidarity and cohesion. And we now have the security demand. The defense industries are going to demand an awful lot of capital. So when I say urgent, it's incredibly urgent that this, it always was urgent, but now it's more so. And I suppose I'd add another reason why it's urgent. And we talk about the strategic autonomy, as so often France has led the way in this, in the thinking. I mean, the Brits, I'm sorry to say, laughed a little bit and the Americans, poo-hooed it completely. But the strategic autonomy is a necessary thing. I mean, President Macron talks about the strategic dependencies of the EU. So China, were dependent for trade. Russia, we were dependent for energy. The US, we were dependent for security. But I'd also say for capital, we were dependent on the US as well. So these strategic autonomies need to be addressed. If Europe is to be strategically important in the world, it has to be autonomous in key elements and areas of public life. So trade, energy, security, and capital are all necessary conditions for a functioning economic bloc as big as the EU. So again, massively strategic and massively urgent. I suppose my overall thought on the SIU is that you can't legislate a market into existence. You can only create the conditions, the incentives, be a catalyst to the markets coming into existence. And I think that's what we've got here now. None of these individual pieces of legislation or reviews will magically create a market, but they will help change the incentive structure for the European citizen and for European industry and for European markets. So hopefully they will be sufficient to kickstart, they will be the right catalyst. If I could possibly, Laura, if you give me a chance to be, I'm quite often called Eeyore from Winnie the Pooh. I see the downside in things. Why did these previous initiatives not quite work? Well, I think first and foremost, there was political resistance. At the most senior levels, the heads of state, everyone agreed that it's a really good idea. And then you get into the mid-level technocratic territory where people have positions, they have incentives, they have something to lose. And so it's centralization, integration, consolidation necessarily probably demands winners and losers. So the national incumbents are not necessarily very keen to see outside larger firms coming in. So the banking industry finds it hard to consolidate. The regulators quite like being in charge of their domestic market, so they make it more difficult. I was very struck with one data point in the Commission proposals. They said that the current barriers are equivalent to 100% tariff on EU financial services cross-border. Now, 100% tariffs, we have just passed that threshold for China, apparently, but everyone's saying the economic catastrophe that will ensue from 100% tariff on China, well, the EU has been living with 100% effective equivalent tariff between its member states and not addressed this problem. So what's a good analysis for Trump is good enough analysis for me about Europe. We have to address that 100% tariff. We also have a cautious investor culture, which needs to be addressed by consumer education. And I'd say, and as a Brit, though I'm also Irish, I point out to my European friends, Brexit did a lot of damage to this idea of the Capital Markets Union. It took out possibly one of the world's largest global financial centers and forced the EU to reconsider and start again from scratch. So that's on the UK, but that doesn't absolve the EU from trying again and urgently. So I'll stop there with my initial remarks.
Thank you, Alan. And indeed, you remind me how we were all stunned by the Brexit agreement when there was nothing on financial markets and capital markets. It was just showing how unprepared we were to this shock on the economic and financial front. Thank you very much. And I mean, we will also go back to the point you made on the geopolitical context and the impact of trade tariff and trade wars on financial markets. On maybe one question for Atanas, what do you think is missing from the SIU communication that we would have loved to see? You mentioned the question of supervision. I think you mentioned common supervision and the name common is not there, for example, but do you see anything else that should have been there and is not there?
Yes, thank you, Laura. Maybe I can just add something from what Alan said, which I think was very important. We are missing some of the growth and some of the investment that we could have if we didn't have this internal barriers to growth, which we have created for ourselves with this fragmentation. It's exactly as Alan said, one could now very easily think about it in terms of comparing it with the tariffs. You have internal tariffs between the member states due to the differences in financial markets, to the lack of synchronization, of regulation, of laws, of supervision. And one should think about it also in a sense of we are missing opportunities. And the best way to see this is people know how much in the last, let's say, 10 to 15 years, how many startups have been created and then have migrated from Europe to the US. This is really, we are losing the best, most innovative talents that the EU has because they have better funding opportunities. There was a very good example some months ago. I will not mention which firms, but some firms that were saying, well, of course, we'll do our IPO maybe in the US. So we should really sit down and think about, we want this to continue happening. If you look at also the venture capital size, the size of total funds raised in the last year, there was an IMF study that compares them, and it seems that in the US, there were 10 times more than in Europe. In Europe, there were around 130 billion, and in the US, around more than 900 billion. So exactly there, where we want to invest in innovative companies that can grow a lot, that can bring a brand, that they can retain a brand in Europe, something that we want, we are not using these opportunities. And we should really understand, well, if you don't use it today, if you don't use it tomorrow, people will look for other opportunities and go there where they have better opportunities. Now, on your question, Laura, one thing that I'm missing, and I've been talking about this for some years now, is consensus on whether we need more euro-denominated assets, safe assets, and I don't think I could say that in a better moment than today. We see it today, what it means for a very long time. If you were in a dominant position, if you had bonds which are considered as a safe asset, we see what it means for a country to, at least from my point of view, win the benefits that it takes from this having a safe asset. And one could think on the opposite way, one could think what Europe has been losing of not having enough of this. And with the pandemic, we created a common European safe asset for the financing of Next Generation EU, for the financing of the Recovery and Resilience Fund. These bond issuances, at least from my perspective, have been successful. They always have a very high coverage ratio. They are bringing interest also outside of Europe. They are, I think, ensuring very competitive cost of capital for the European Commission. So on all of that, it seems to me this was a successful experiment. However, of course, it has its limitations because Next Generation EU issuances, they are only there for the 5 years in which this happens. And basically a limited issuance also means, well, limited liquidity. So they would never be the safe asset that you can really use as a benchmark for a capital markets union. And a capital markets union, or right now savings and investment union, a unified capital markets, it seems, at least from the macro perspective, always needs some benchmark, some risk-free, safe asset that you can always use in times of stress, that you can always use for basically benchmarking all other bond issuances and all other activities on capital markets. So this is something that has not made it, unfortunately, in the communication, in the savings and investment communication. It was mentioned in the Draghi report, so I think it's unfortunate that it didn't find a position in the communication. Of course, there are huge differences between member states on, do we want some form of common bonds? What for? How do we do it? And we saw that in the pandemic, the shock was so big that it made all member states agree that, well, for some investment needs or for some stimulus programs or for some financial market stabilization, we agree to do that. Of course, there are others that say, well, they should only be temporary. But in the end, we have to admit that this has also other macro implications, but it also has the implication that it doesn't give us this main pillar, this main benchmark for the capital markets union, as long as we don't have this safe asset and European safe asset.
Thank you. Yes, indeed. And as you said, probably a huge missed opportunity, even in the past few days, where we hear investors are shifting their assets from US to EU already. So the existence of a euro denominated euro bond type of investment product would be fantastic. But anyway, before we dive further into the impact of the US policy on the potential development of SIO and financial markets in Europe in general, I have a question for Alan on sustainable finance, because one thing that I saw from my perspective missing from the SIO communication was reference, or at least cross-reference, to sustainable finance, which even though there's been a recent backlash, it has been one of the top policy and regulatory area looked by banks and funds in Europe over the past years. So EU and member states have been leading on the issuance of green bonds. And in fact, this is not just in the past. It's not history at all, because last week only the European Investment Bank has issued the largest ever bond aligned with European green bond standards, 3 billion euro, and it met very strong market demand. So there's a question there on if there's not a missed opportunity for Europe to factor in the sustainable finance efforts that have been made within the SIO at large.
Absolutely. I mean, it's akin to the Atanas's last point about the Eurobonds or euro-denominated debt. This could become a safe asset class. The EU has a very successful track record. It's linked to one of the goals, which is to finance the climate change transition. So there's a very obvious political and means to an end inherent in this. I mean, I couldn't agree more. I think that, Laura, the EU has missed a trick here. I think everyone's very nervous since November about talking about this. Hopefully they're doing it behind the scenes. The US is putting a lot of pressure, I'm sure, not to have this as part of the discussion, but the demand is clearly out there. As you say, I mean, there was a heavily subscribed issuance. So I would hope that the EU would stick to its guns and keep issuing this and keep promoting it. If the US, and I saw the central bank governor of Spain today was talking about the problems of US debt and the reserve currency of the dollar, and in very speculative terms, obviously. But it seems to me that this question comes around every few years, is the preeminence of the dollar, and comes under question. I mean, it's come again. But for that to be a real question, there has to be alternatives. People are piling into Swiss francs, Japanese yen. Those are they're big currencies, but they're not big enough to absorb the switch in demand. And then it pumps the price of these currencies massively. So it's a dangerous place to be if you don't have the supply to meet the international demand. So the EU is a safe haven, but is it big enough to absorb what the global demand? And the answer to that is, I don't think so, because it'll put upward pressure on the euro, unintended perhaps, and unhelpful, very unhelpful, unless the EU can meet that demand and help stabilize the price a bit. So sort of linked to Atanas's point, I think the EU should be absolutely seizing this opportunity at the moment on euro-denominated debt, euro bonds, things that the market wants to buy and feels is safe, in a way that they can sell it into the market without hurting their own price levels of the asset. So there is that sort of sense of this is an opportunity that needs to be seized. I mean, as a silver lining, it's pretty thin, but it's something I would consider, given the silver lining in the sense of the storm clouds are big, but something you need to have some positivities in all of this to help. I mean, you said what's missing from the package. One thing that's in the package, but I don't think has enough prominence, is securitization. It was sort of blamed for the financial crisis in a strange way, and has a very bad political reputation in the European Parliament, for example. I honestly cannot see why. It's a very sensible instrument to package up bank loans, take them off the balance sheet. It's a gift to the capital markets. It's a huge asset that could be used in the capital markets and traded, and it also frees up bank lending. So it's a double win, and I think either it needs an intense education effort to tell politicians and policymakers why it's a good idea. But I think no one in the markets and quite a lot of policymakers, I think, certainly in France, would agree that actually it's completely necessary. So maybe that's if we're going to focus on anything in the SIU, maybe that's one of them, because I think that would be a very big, quick win if we could get that rolling.
Oh, absolutely, and indeed, there's this securitization proposal that comes, in fact, before Q2 25. So we will see it coming very soon. But the language so far is very general, so we will have to see the details of what it means to have capital relief, for example, to promote more securitization, and that's indeed a massively efficient tool to provide access to finance to smaller holders, to smaller borrowers. So maybe now we're going to turn a bit more to what's in the news and the obvious elephant in the room here, which is the trade and economic policy coming from the US, which has shown a complete shift, as we know. And for now, the policy announcements were on tariffs and trade, but there's a general policy from the US that, as you mentioned, Alan, they are feeling that their role as the US dollar as a reserve currency is not providing them benefits anymore. And that means there is a shock now on the financial markets with the tariffs announcements and the shift of assets, which can be quite violent, and this starts impacting very negatively the European financial markets. But there might be more to come with the currency equation raised by the US, and that, Alan, you just illustrated with Japan and Switzerland. So maybe on that, Atanas, is this? What do you think will be the most important impact of this new trade and economic policy on European financial markets?
Sorry. Thank you, Laura. We are going through very difficult, maybe historical times. I would say times that maybe mark a regime shift. This is a decision that the US administration has its own reasons to do and their own views on that. I would like to talk about what these days, and now actually it's like 2 weeks already of extreme uncertainty, extreme shocks and things happening that are extremely fast and very volatile. Unfortunately, of course, this makes it more difficult to argue, well, people should have higher participation in equity markets, people should use their savings more actively. This is unfortunate. And of course, if people are risk averse, in Europe, they are more risk averse on average, it seems, that would lead them to the conclusion, unfortunately, for a very long time, most probably, that it is too dangerous for households, for retail investors to participate actively in equity markets. Still, however, we have to admit that for many years now, equity markets were bringing high returns. 2022, there was a period of volatility, there was a period of panic, but it seems that the supervision worked, the requirements worked well. It was a short-time shock. There was a shock to banks in the US that didn't spread across the world. So my view is that, well, regulation got better after the global financial crisis. It has led to much less volatility in the last 15 years since then. But on top of that, we should, of course, always admit, well, we want, and we see, at least I see it as better if these savings are used more actively in Europe. But that doesn't mean more risky. You should still take the path of knowing what you're doing, right? So the fact that there is this extreme volatility now and uncertainty will have a mark on people's decisions, whether this is a good thing to do capital markets union and savings and investment union. I realize that, but we shouldn't make, I think, huge conclusions because, I mean, equity and capital markets have been there now for centuries or decades, and we shouldn't take everything that is happening as the end of the world. On the other side, as I said, these are regime shifts. These are changes, I think, that would really erode the dominant position of the dollar. I don't subscribe to the view that this will be something to the benefit of the US. I realize that there are people in the administration that think so, and I've read, of course, the views of some of the representatives. I believe more that the dominant position of the dollar has led to exorbitant privilege. It has its duty. We should not, I cannot say that it's not true. It has its duty that the reserves of that the decisions of the Federal Reserve have implications for the global financial system. That means that sometimes the decisions that the Federal Reserve is taking are not only with consideration to the US, but with consideration for other constituencies. Maybe this is a duty and a burden that the US doesn't like, maybe, but I wouldn't say that the downside of this is too much. So I don't agree that it is a good thing to erode the privilege of being the global reserve currency, but it seems that this is the way we're going, at least at this point in time. We'll see how this goes really in very, very volatile times. I regret these developments, but they are the developments which we are seeing.
Thank you. And I will ask a similar question to Alan, but maybe focusing on the question of strategic autonomy you raised earlier, the fact that the US being such a leading player on financial services, we get basically into the turmoil. And is there something where the EU there could have a greater role in the future, thanks to SIU, but also thanks to the current dynamics? I will just, before Alan answers the question, I will just point at the fact that we have a Q&A session that will start in a few minutes. So if you want to post Q&As, there's a special section on your screen. And I already have a question there that I will read after Alan respond to my question. Thank you.
Thanks, Laura. So, I mean, well, yes, I agree with that, Tanash. What's happening in the US is highly unpredictable. It's very volatile. It's very hard to analyze something in real time. They used to say it's like changing the wheel of a car when the car is moving at 80 miles an hour or 80 kilometers an hour. So it's what do you say in this situation that won't be out of date or make sense in 5 minutes' time? But I suppose where I would start with the EU is, what is the counterfactual? Is the EU better off or worse off in the current situation? And would it have been better off if it had a fully functioning, big capital, deep liquid capital market? I would say the EU would be in a stronger position, not a weaker position, given what's happening in the US. So actually, now is not the time to take fright. Now is the time to say, actually, if had we moved earlier, we'd be in a better position, and we would still be in a better position even if we're moving now. And it's very hard to interpret what is being done in the US in policy terms, not least that there are contradictory commentators within the cabinet telling us what's happening. But I mean, there are fears in the market of financial repression. I mean, the forced restructuring of government debt, but 100-year tenor will be enforced in some market players. That's extreme financial repression. So that gives a huge opportunity for, how can I put it, well-managed capital markets with predictability and rule of law and long-term sustainable policies make it more likely that you will find customers in the market than if you do the opposite. So I'm not saying that's what's happening, but it's a feeling that's growing that this turbulence is not well directed, or the philosophy behind it is not coherent. And I would say, I mean, and this is a question for geopolitical analysts and legal jurists, but I think a large chunk of the stability of the US markets comes from the absolute faith in the rule of law and the courts. And if the administration starts to defy the courts I mean, they're doing it on social policy and immigration policy, but defying the courts is defying the courts. And if people start to think that actually perhaps maybe financial repression and legal arbitrariness are growing in, are a growing phenomenon, that makes it less likely that people will wish to hold dollars in the first place. So that creates, again, a demand elsewhere and an opportunity. So those are my sort of very Eeyore-ish thoughts on what's happening in the US. I hope I'm completely wrong, and I probably am wrong. It wouldn't be the first time, but it's when you see this degree of chaos and market turbulence, you really have to ask yourself if the fundamentals are not under attack.
Thank you. And indeed, and the irony is that Stephen Miran, in his paper on the new trade order, the chief economist of the Trump administration, he actually mentioned the fact that the Chinese currency cannot be a reserve currency because there's no rule of law, or there's perception that China is not the place for rule of law. So they actually believe even themselves that this is a fundamental that will have to be
If I could
respected.
offer our viewers, I always like signposts and signals. It's very good when you're making policy or strategy to look out for signposts that pop up along the way. Court decisions in the US, whether they are followed and obeyed or rejected, those would be my red flags or red balloons for this particular question.
Thank you. I will just take 2 minutes for Atanas to develop a little bit more what he said on supervision, because that's a very important point that has a lot of debates among member states. And then we'll move to the Q&A session with the audience. Atanas, can you tell us a bit more on what you hinted at on the common versus harmonized supervision, and maybe outline what is at stake there, and how, I mean, why this is such a crucial element of SIU?
Yes, thank you, Laura. Well, it is a bit like thinking about banking union, thinking about the ECB, thinking about common European institutions, common regulation. In the area where you want to reduce fragmentation, you can do it by doing it in two approaches. You can just say to member states, well, let's all do the same. And this is harmonization. So we'll also all hold the same laws. And I basically mentioned some of the crucial parts, which are always mentioned for many years, where we need harmonization, insolvency law, tax withholding, tax treatment, and others. And in this area, for many years, we have said, well, we have to have the same regulation and rules. And my view is that, well, maybe there has been some progress, but again, as I said at the beginning, it was minimalistic. If we want to achieve the same treatment, another approach is to have one institution that does that. Currently, we don't have this one institution. We have it for monetary policy, we have the ECB, we have it for banking supervision with the SSM. It was a very long fight until the SSM was created in 2012. And I think we see that, well, things that, at least for me, seem inherently necessary for a single market will happen sooner or later. You can wait until a crisis shocks you and you realize, well, we need that and we have to address this, or you can try to do it with some progress in time. Unfortunately, the second very seldom happens because member states, as Alan also hinted, often have absolutely, maybe rightly so, the interest that they keep some of these competences at their member states level. So without a shock, they are not willing to give this up. But they have to always think about, well, you are having higher competence, but you are losing something from the fact that year after year after year, we are continuously accumulating these losses of the fact that we don't have fragmentation. As Alan said, year after year after year, we have higher tariffs or barriers, or as you like to call it, between ourselves, which we don't have to. And by not moving forward, we will continue having this. The goal of harmonizing supervision, again, is maybe the politically realistic one in terms of framing, but in the end, it doesn't really move. That means that it doesn't deliver. We can agree that we want to harmonize, but then we don't agree what we want to harmonize or how we harmonize it, so nothing actually happens. The other way would be, well, let's say we need one institution and we agree that, well, that would mean losses in terms of competences in some areas. But again, this will be up to the member states to decide exactly how much, right? And currently, it doesn't seem that they have the appetite to decide on anything. So that is again their choice. Yeah? There's the choice that has some costs on the European growth model and the European funding landscape, banking and financial landscape, and therefore also to whether we do all these investments, whether we use the funding we have, whether we use smartly the funding that we have, and there would be a need for some compromises there.
Thank you. Thanks a lot. And I will now turn to the question that's on the chat. We'll read it for everybody. The CMU, now SIU, has been positioned as an enabler for the EU to invest more effectively in innovative sectors which can deliver future growth, such as pharmaceuticals. However, only financial services policy professionals are really positioned to understand how the proposals could work and what the outcomes could be. How can potential beneficiary sectors best understand the proposals and determine if and how to engage on them in more detail? I think that's an excellent question. I think kind of technical language we use even when we try to stay at on a strategic level discussion is telling about the fact that some people can be left aside in this conversation. Would you have any opinion on that? Alan, Atanas, please.
I agree with the point that a large chunk of this is on the wholesale side, and that's very esoteric, and it's not necessarily designed for NGOs and consumer groups and others to really get to grips with. But the answer, of course, is this consumer education, and not just consumers, but consumer education organizations and your trade bodies for different sectors. I mean, this is a job of work across a whole sections of society to get involved. Yes, your professional banker or insurance expert isn't necessarily going to be able to explain to the person on the street, but investment advice has to be given professionally, and the professionals have to be able to understand this, and then they can advise at the retail level. So I slightly reject the premise that it's opaque and impenetrable to everyone in society, but you need to go through professional bodies to understand what's happening, and governments need to explain it too. I mean, there's departments of education, finance ministries, etc., all have a role to play here to explain. The business ministry in your country, the enterprise ministry, should be explaining how this works for SMEs and for individuals. It's not the job of one group of elite professionals. It's meant to be society-wide, I think.
I have a couple of points on that because I think this is crucial. That's why I said at the beginning also the rebranding is for me at least a good thing. For a very long time, the branding of a capital markets union sounded as something very convoluted. It's only something for the financial sector, whereas now we actually talk about things that people understand, also both like on an everyday level, but also macroeconomic, or even people that have nothing to do with macroeconomics know, yeah, well, you need some savings to invest, right? And we have these savings in Europe, and we want to invest them better instead of basically not investing it in a way today. And it is true what Alan said, it has to be basically done by everybody who will be somehow part of this increased investment and savings to explain what it means. Because I'm sure, and I already unfortunately hear that, I mean, some views there will be that, okay, this will be somehow unequal treatment of our savings or something that is, let's say, not in the benefit of households. It's exactly the opposite way around. It is about using the capital that you have. And here, this is the example I give also to my students from a macro perspective. Yeah? You have capital in Europe. You want it to go where it is, let's say, the most efficient. You want to allocate it in the most effective way. and for it to invest the smartest thing, so to say. And the easy example really that one can say, and that I sometimes also use on TV, is that if you compare how in the US, your pension fund invested in some of the startup companies, I mean, they were startup companies 20 years ago. Now some of them are the leading technological companies in the world. You should think about the returns that meant for your portfolio. And if you're not doing that, or if you're not even allowed to do that in Europe, well, you should also think about the costs or the missing benefits that you're missing out of this. And the same goes also for firms side. It also goes because we see, as we mentioned, that, well, some firms decide the landscape, the funding landscape in Europe is not good enough for us. So we'll have to search for other opportunities. And these other opportunities means, again, we are losing both the talent of some talented people that have ideas that could be developed further in Europe, but also the really economic revenues and gains of this activity taking place here in Europe, because we are not delivering on their needs.
Thank you. And I will, there's no other Q&A question in the chat that I see, but of course, there's still a few minutes if someone wants to post it. I have a question myself on what was said earlier, because both of you mentioned the urgency of the situation and the potential missed opportunity. My personal view when I looked at the timeline of the different proposals of the SIU is that it's at least there's a timeline, but it's still very long. And some of the initiatives are planned for Q3, Q4, 26. So do you think, it's a very simple question to close the webinar, do you think the EU policymakers, whether that's Commission or member states, really get the urgency of the situation and the fact that there could be a huge missed opportunity if we were not to deliver on this?
Having worked in the Commission, I know there are capacity constraints. So you can't do everything all at once. So you do need to prioritize and sequence things. Hopefully they're not just going for the low-hanging fruit first and leaving all the difficult ones to the end, which sometimes happens. I think if I were, I agree that there needs to be more urgency. And a lot of this was written before the current turmoil. I think the turmoil in the market suggests they need to speed up, not slow down. But they need to do it in a considered way, which is maybe a contradiction. But I think a lot of this comes down to the politics and the national turfs, a turf battle, territorial battle between member states. And I think that's where they need to sort first. So maybe the regulators could show the lead and say, we will put aside our national preferences and we will support the integration, as Natanash was saying, of the single supervisor. Let us show willing, let us lead by example and put aside our preferences, personal preference, national preferences, and show the way to the others to lead by example. That, I think, would give me great comfort, that they saw it as seriously as I think we all do.
I'm a bit more, I'm on one side, I'm very much more optimistic because I saw some steps. I saw the letter report. The letter report said, okay, let's move into this kind of new framing and let's think it through from this point of view. And only a couple of months later, the Commission indeed embraced this approach, which I think is useful in terms of communicating, in terms of pushing of, okay, this is what we are doing and why we are doing it. So in that sense, I agree. On the other side, well, as I said, the communication doesn't have all the missing pieces. And on some of the pieces that it has, we've been there already for many years, right? So it's not something that I'm surprised that I see this. No, if you go back, you'll see it also previously, and you'll also see it in statements that were agreed by all member states. For example, last year, there was a joint statement both by ECOFIN and by the Governing Council of the ECB, embracing the further steps to be done in the Capital Markets Union. And now some of them are part of the communication. And I just hope that we will just continue with this. Okay, we agree on everything. Now, how do we implement it? And as soon as we start with the technical details, we find reasons to disagree or not to move. On the other side, I have to also be realistic. Again, what we said, the current turmoil is not going to be easy to handle for moving forward to this idea, because it also means a more volatile world where you're not very sure whether the steps that you've been that have been easy to agree on previously still will be easy to agree on.
Thank you. Excellent. Well, I think we will close here because we're reaching the time limit, but it's been a super helpful discussion, I hope, for our audience, and for me personally, it was very interesting to hear your views on all this. We'll see how it develops, and we might have a follow-on discussion similar to this one when things evolve. Surely they will evolve in the coming weeks and months. Thank you very much, Atanas, Alan, and see you very soon. Bye-bye.
Take care.
Thank you,
Thanks very
Laure.
much.
Thank you, everybody.
Bye-bye.
Bye.